Hi guys, today let's have a conversation about how bonds work. Now this would apply to corporate bonds, treasury bonds, as well as municipal bonds. The easiest way to typically think about a bond is that it's essentially a loan that goes from a company or a government to an investor in exchange for a fixed interest amount each year. At the end of the term, as listed on the bond agreement, the investor receives a lump sum payment for the amount that was loaned to the company or the government. During the life of the bond has a market value, so the bond can trade up or down all throughout the period of time, with the investor that holds the bond at maturity, the one that collects the ultimate value of the bond. With a bond, there are a couple main components that you should understand. The first is the face value, which can oftentimes be also referred to as the par value. Now, for most bonds, the face value or the par value is usually 1,000. And that's typically what an investor will get back at the end of a bond maturity. And at the time the bond is issued, there is what is known as the coupon rate. So for this example, let's assume that the coupon rate is 5% for this $1,000 bond, which means that 5% of 1,000 is $50, and $50 is what the individual or the investor will get on an annual basis for owning this bond. And after the bond is issued and it's in the market, there are investors that could both buy the bond or sell the bond. So if there's a heavy demand for a bond for 5%, investors can come in and bid up the price of this bond. So let's just assume that this bond is very popular and a lot of investors are piling into these bonds. This bond, for example, could trade at $1,200. So at $1,200, this investor is still only going to collect $50 for each year. So this actually gives this bond now a current yield of about 4.2%, which is less than the 5% that this bond was initially issued at. But remember, since this bond was a $1,000 face bond, the person that buys this bond for $1,200 will still only get $1,000 at the maturity of this bond. So that's another factor that this investor would have to think about when they purchase this bond. So just like a lot of things, bonds, like stocks, have a lot of risk and reward built into it. So now you have an idea for why when bond prices go up, the interest rates tend to go down. And when bond prices go down, the interest rates tend to go up. So when you hear the Fed come out and say that they're buying a bunch of bonds, what they're trying to do is essentially keep interest rates low. So that's a 101 on what you need to know about bonds. Hope you guys learned something new, and I'll see you guys in the next one.